Warning. This video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all. Alright, hello and welcome to Camel Finance. I'm your boy Camel, and slowly but surely the charts are seemingly showing some improvements, but I still think there is elevated risk and uncertainty present. So I'm going to show you that the cycles still project weakness. So again, it tells us that the breakouts are not necessarily to be trusted. That doesn't mean there won't be some trade setups coming, because I think there are, but like I said, still a lot of uncertainty, still a lot of conflicting data in the charts. Once again, we continue to see this theme unfold post-Olympics, right? We continue to see things like the most recent round of cyber attacks. And of course, I still think these things are largely functioning as warm-ups for the big day. But as I often say, okay, the big day is some time away now. We also had this pretty interesting piece of news for me in that MetaMask has launched a debit card. Okay, a debit card that you can link to your own self-custody wallet and then spend your crypto on. Slowly but surely, our magic internet money is becoming more and more like real money. But I know a number of people have said this is the kind of thing that we should probably expect to see close to tops or to discourage retail from selling. As ever, there are two sides to every coin. Of course, yesterday, the big news was that we had the CPI data come in and it was a little bit muddied, okay? But overall, headline is below the forecast and prior readout, moving in the direction we wanted to see it. And the same is true of core, okay? So happy days so far. And whilst we were expecting to see, largely speaking, a colder print, it is, of course, the next month's readout that we should expect to see the biggest drop-off and the fastest acceleration to the downside in the CPI data. So I think we can tick this one off as wholly speaking, or largely speaking, moving in the direction that we wanted to see. Like I said, it's the next month's print that will be imperative for the Camel Crew. As always with the CPI, if you know where to look, okay, you can get a completely different view on the data set relative to just the headline or the muddy data set, the seemingly muddy data set that was released yesterday, which is what most traders will be looking at, okay? But when we dive into this a little deeper, core goods is still deflating. Prices fell 1.7% over the last year, which is the same as May and June. And even though housing wasn't as mild as in June, the 3-month annualized rate held steady at 3.9%, and the 12-month rate fell to 5%, which is the lowest in 2.5 years. Core services, excluding housing, has slowed a lot over the past 3 months after a big turn higher in Q1. Take a look at core goods down here, okay? And then everything else at the hard right edge also trending down. So again, instead of looking right at our noses, we continue to look out into the future. And again, we continue to understand that it is not the print on the day or the numbers that are released that are important. What is important is the overall trend. When we look at the core consumer price index change from year earlier, again, core goods in the negative territory. Everything else at the hard right edge, continuation of disinflation, okay? The trend is going in the right direction. Just like the way markets don't move in straight lines, there are pullbacks and dips along the way. The same is true in macro data sets, okay? So long as the trend is down, we can tolerate a few wobbles here and there. Overall, as you can see from this, the trend is indeed down. So what does this mean? It means, once again, the Camel Crew is on top of this whilst everyone else is looking at the data set in here and saying, well, this is kind of sticky, right? This is kind of sticky, but the facts are the facts, and this is not actually a sticky data set. As of yesterday, okay, the slightly or perceived slightly stickier inflation print has led us to lean more in the favor. It was about 50-50 going into yesterday's CPI data, and we are now sat at about 65% probability, just under, that we are going to see a 25 basis point cut instead of a 50. But with that said, the bond market, okay, this is the US 2-year yield, does not believe it at all, okay? Still looks heavy to me, looks like it still wants lower, and remember, the more this thing breaks to the downside, the more likely it is that we will see the 50 basis point cut in September. So tell that to the bond market is still very much in play. Okay, this chart is from April. I've shown it a million times before. When the 2-year yield moves lower, it forces the Fed funds rate in orange to follow rapidly thereafter. Okay, remember, it's not the Fed that's actually in control of choosing whether or not to hike rates or change rates. It is the bond market in aggregate that determines when the Fed will cut. And so, like I said, this chart is from April, okay, but I made an updated version as of yesterday, and you can see, okay, here's the update. really starting to move in that direction where, historically speaking, we have seen the Fed be forced to cut rates in every other instance. Again, I sit here and tell you to tell that to the bond market. And of course, the reason I think this is so significant, the reason the melt-up chart has had "do they cut here" in white text right above the top for the entire time, is because the nuance with rate cuts relative to the S&P is as follows. If we are cutting into normalization, rate cuts can be bullish for the stock market and risk assets in general. But if these are cuts into a slowdown, or because something is about to break, or because there's financial stress in the system, or because we are slowly but surely working our way towards a debt crisis, then those rate cuts are not bullish for risk assets. And so if you're in the camp of people that thinks everything is fine, the economy's not slowing, there's nothing to worry about, okay, no fears of recession, we're going to ignore the labor market deterioration and all that other stuff, then you could perhaps be thinking of these cuts as a cut into normalization, or said another way, cutting rates as inflation returns to its baseline 2% target with a soft landing, with no recession. But if, like me, you think the time that we're in today is very, very similar to the prior times that we saw the rate cuts, which of course were not cuts into normalization, then what we saw is the stock market, the S&P in white here, drop 50% peak to trough just after they started to cut rates. Okay, it's the same here. Just after they start to cut rates, we see a 57% decline in the S&P 500. We saw the same thing here. Just after they cut rates, okay, the market rallied for a little bit, but then it experienced a 35% decline. And so the big question for me is, if we're going to see these cuts in September, is the top already in? Have we got one final leg higher? Can we even extend the rally for a couple of months post rate cut? Which, of course, if it occurs in September, would take us out to around November. But like I said, the big question for me, and I think most of the Camel Crew, is if we're going to continue to tell that to the bond market, meaning if the 2-year yield is going to continue to force the Fed to cut rates by September at the latest, have we got a major top for the stock market developing over the coming months? I think we do. Again, one day at a time, and we'll see what the market will give. So before I get into the charts, I will say this, okay? There is a number of subtle improvements showing up on the charts, but risk remains elevated, particularly if you have an awareness of cycles. And you can see this reflected in Bob Lucas's opinion here. He's one of the biggest cycle traders on the internet. He says, look, for people asking for his views on Bitcoin, the honest truth for intermediate term is really murky for Bob, and for me as well. He says he doesn't have a good read, neither do I, that's why I'm flat, and that he sees forces pulling in all directions, so limited trades and a happy spot holder. He did recently add some more spot. He says, mostly I feel like Bitcoin got flushed out recently and continues to be in a massive accumulation zone, but he certainly doesn't expect anything until mid-September at the earliest, something he's discussed a few times, range bound in the meantime. The bulls, however, might need to wait until the December weekly cycle low, which would make this a 9-month range, and that is a possibility, see the chart. And there's also a third option, which is more lows are to come. There's always room to be surprised, and spot holders would be severely tested if we get new lows. At deeper lows, the entire bull market narrative would have to be questioned, and unfortunately by then it's probably far too late to want to take action. But this is the game we play, okay? This is the joys of investing. Overall, he sees no reason to doubt the 4-year cycle, since we are not even halfway through it just yet, nor doubt the idea that a 4-year cycle high is still ahead mid to late 2025 at a 6-digit print north of $100,000 per Bitcoin. So that keeps Bob sane. From a cycle perspective, okay, we could, in theory, have just forced an inversion here, a capitulation trap as he labels it, and be looking for the blue path, an acceleration to the upside. Or, as you can see from the red path here, we might have a whole heap more time to elapse until we find another weekly cycle low somewhere around the end of the year, and out of there we might have a shot at moving higher. Again, by the time we get here, this will be a 9-month consolidation. I noticed something Bob isn't looking for, but the Camel Crew are, is that this is a half cycle low inversion. And well, I guess he kind of is with the blue path here. And I also noticed he's taken off the idea that there was another daily cycle low somewhere in this neighborhood. Okay, so daily cycle low, failed cycle, daily cycle low, and go. But as you can see, okay, there is still a lot of risk. There are a lot of people that would like to tell you they know exactly what's coming next, but those people are liars. They are liars, or they are naive and mistaken. Okay, nobody knows. This thing could really go either way. And Tony the Bull points out here, okay, the 2-month LMACD shows bearish momentum is increasing in altcoins after 900 days on the red of the histogram. There's only 17 days left to turn this thing around. It really is now or never. Again, potentially bad news if you're an altcoin holder. And for the S&P, whilst you're about to see when we get to the charts, okay, things are slowly but surely looking better. But given where the cycles are, okay, we've had a fast counter rally in stocks after a sizable sell-off. Generally, this type of flush leads to a lasting low, but this came in early in the cycle, implying there's probably still one more multi-week move to the lows. That's at least what the cycles suggest. So from a cycle perspective, we should still be looking for continuation to the downside and one further low. Now, of course, if this thing keeps going to all-time highs, this represents an opportunity to buy back, having managed the risk earlier on in the cycle. But like I said earlier on, despite the seeming improvements in the charts, okay, cycles still project downside risk. There is still no clarity in the current setup. As it stands, okay, maybe this is a day 44 low, or maybe we failed early here and this is about to reject resistance and roll over. Time will tell, okay? Breakouts for me are to be respected, but again, risk remains elevated given where the weekly cycle low currently sits. I do not think this is likely a weekly cycle low just yet. The Nasdaq has made its first line of repair and is back above its second angle, okay? Very, very encouraging signs so far, but there is nothing to say that this isn't going to reject somewhere in this neighborhood and roll over. Again, longs are sat here ready to be executed on if we can see technical repairs made. And the Dow Jones is also showing some encouraging signs getting back above its second angle, okay? Some kind of wiggling around above this line and then a breakout could certainly be me re-entering long. Time will tell. Okay, but for now, this could certainly also be breakdown, retest, resumption. Again, cycles still project weakness, not the best setup to be getting long at this current moment in time. Gold is getting pretty stretched. Feels like it wants a nice puke lower to find a weekly cycle low and a daily cycle low. And then I think we've got an enormous opportunity for the metals. And I'm noticing silver thinking about breaking out. Okay, but the fact that gold has compressed high up whilst silver and the miners have not followed, to me, is a little bit ominous and tells us not to really trust the move in gold. Again, a little bit more patience should help us to determine the true direction of where the market is about to go. And of course, Bitcoin still contained below resistance, still contained below its second angle, still printing lower highs and lower lows. Okay, and this daily cycle, which should be about here on the chart, okay, should, in theory, form lower down than both this wick and this wick, unless this is a cycle inversion, unless this is the weekly cycle low and we're about to blast off. If so, then again, I have a good track record of catching the momentum when it returns. But right now, there is a lot of uncertainty. And if there's any merit to Bob's idea, okay, then we may well have something like this playing out right into the end of the year before we even have a chance at moving higher. The one thing that could be our saving grace, okay, is the DXY. If the dollar can indeed move down towards that 3-year cycle low, and if it can do it in rapid fashion, then we might just have a chance to force some third and final angles across the board. As I said a million times, okay, and hopefully, as you can see already, there's a lot of mixed messages, there's a lot of uncertainty, and the read is not very clear right now. There's a time to be in, there's a time to be out, and there's a time to go fishing. Right now, for me, is a time to be out, okay? Once clarity returns, and I don't care if it's in days, weeks, or months, at some point, clarity will return, and I will be happy to get back to max exposure. But there is no point, as far as I can tell, in having made such fantastic gains, having demonstrated since the inception of this channel how to get behind these squeezes and capture the meat of the move across multiple asset classes. There's no reason for me to be guessing here, to be picking a direction and marrying it when currently, okay, as you can see, there's a whole heap of uncertainty. So when clarity returns, I'll be ready to return to the market as well. For now, from a trading perspective, I continue to sit on the sides and wait for quality setups to present. So I'm your boy Camel. I hope you're doing well in life. And until next time, take care from me. All the best. Cheers. Bye.